Ever wondered what private equity really means and why it's such a buzzword in financial circles? With $4.4 trillion in investments and 12 million jobs tied to it, private equity is a major player in the global economy. But how does it impact you? Welcome to All Things Finance. In today's video, we are breaking down what private equity is, its structure, and how it makes money. We'll look into some success stories, scandals and conspiracies, and how all this impacts the ordinary person. Along the way, we'll explore key jargon like leveraged buyouts and hurdle rates. Let's dive in. Part 1. What is private equity? At its core, private equity is a form of investment in companies that aren't publicly traded on stock exchanges. But to truly understand private equity, we need to contrast it with its more familiar cousin, public equity. When you buy stocks of companies like Apple or Amazon, you're dealing with public equity. These companies are listed on stock exchanges, and anyone can buy or sell their shares. The key here is transparency and liquidity. You can see the stock price at any time and sell your shares whenever you want. Additionally, these companies must report their overall health and performance through publicly available financial statements. Private equity, on the other hand, involves investing in private companies or taking public companies private. These investments are not available to the general public and are typically made by specialized firms or high net worth individuals. The trade-off? Less liquidity, but potentially higher returns. Private equity is less liquid because selling a stake in a private company usually requires finding a buyer directly, which can be a lengthy and complex process. There are other incentives, such as less scrutiny, which means they don't have to report to the SEC or shareholders, and more flexibility, allowing them to make bold moves without worrying about quarterly earnings reports. Part 2. Types of equity. Now that we've laid the groundwork, let's explore the different types of equity investments. Number 1. Venture capital, or VC. This is a subset of private equity that focuses on investing in startups. In exchange for their investment, venture capitalists typically receive ownership stakes in the company. Think of companies like Uber or Airbnb in their early days. Number 2, hedge funds. While not strictly private equity, hedge funds are alternative investment vehicles that pool capital from accredited investors and institutions to invest in diverse assets using various strategies, aiming for high returns with higher risks. Lastly, number 3, private equity. This typically involves buying mature companies, improving their operations, and selling them for a profit. To make things more clear, let's consider a real-world example. Remember Yahoo? In the early 2000s, it was worth more than Amazon and Apple combined. However, a combination of strategic errors, leadership instability, and failure to adapt to market changes led to its sale to Verizon for $4.8 billion. Verizon then merged the company with AOL, previously bought for $4.4 billion. As the downward trend continued, Verizon finally sold the combined company for just $5 billion, an enormous loss. The buyer was Apollo Global Management. Apollo focused on Yahoo's core strengths, Yahoo Finance and Yahoo Sports, while selling off non-core assets like Yahoo Japan and Edgecast. With strategic leadership and renewed focus, Yahoo has undergone a successful transformation, now reportedly profitable and poised for a potential IPO, demonstrating Apollo's effective turnaround strategy. Part 3. Financial and organizational structure. Private equity firms raise money from investors, known as limited partners. These can be pension funds, endowments, high net worth individuals, or even other financial institutions. The money is pooled into a fund, and the private equity firm itself acts as the managing partner, managing the fund and making investment decisions. The financial structure of private equity deals often involves a combination of equity or money from the fund and debt. This is where the term leveraged buyout comes from, which we'll discuss more later. At the top of the organizational hierarchy are the general partners, who often throw some of their own money into an investment proposal to raise the stakes. They are responsible for major decisions, fundraising, and maintaining relationships with investors and portfolio companies. Below them are principals or directors who lead deal teams and oversee due diligence. Vice presidents play a crucial role in executing deals and managing day-to-day transaction aspects. Associates, often with investment banking experience, handle financial modeling, valuation analysis, and due diligence. Analysts, typically fresh out of college, support the deal team by gathering data, conducting research, and assisting with financial analysis. It's a demanding role that provides a steep learning curve in private equity. Part 4. How does private equity make money? Private equity firms have two main ways of making money. First up, management fees. They typically charge around 2% of the committed capital as an annual management fee. This fee covers the operational costs of running the firm. Secondly, carried interest. This is their share of the profits, usually 20% of the returns above a certain threshold called the hurdle rate. The hurdle rate is a minimum return that must be achieved before the private equity firm can claim its share of the profits. Let's break this down with an example, using an 8% hurdle rate. Imagine a private equity fund raises $100 million from investors. The fund invests this money and after 5 years, sells its investments for a total of $180 million. Here's how the profits would be distributed. First, the original $100 million is returned to the investors. Next, the 8% hurdle rate is applied. Over 5 years, this would be about $40 million. So far, $140 million has been allocated to the investors. The remaining $40 million is the profit above the hurdle rate. Of this $40 million, 20% or $8 million goes to the private equity firm as carried interest. The remaining $32 million goes to the investors. In total, investors receive 100 plus 40 plus 32 equals $172 million. The private equity firm receives $8 million in carried interest. This is on top of the management fees the private equity firm has been collecting annually. 2% of $100 million equals $2 million per year. $10 million in 5 years, making it a total of $18 million the general partners put in their pockets. Part 5. Leveraged buyouts. At its core, a leveraged buyout is when a company is purchased using a significant amount of borrowed money. The term leveraged refers to the use of financial leverage or debt to amplify the potential returns of the investment. Here's a step-by-step breakdown of a typical LBO. First, the private equity firm identifies a target company they believe is undervalued or has potential for improvement. Then they buy the company using a combination of their own funds or equity and borrowed money or debt. The ratio can vary, but it's common to see 60 to 80% debt and 20 to 40% equity. The debt used in an LBO is usually structured in layers or tranches with different levels of risk and return. This might include senior bank debt, mezzanine debt, and high-yield bonds. Once they own the company, the private equity firm works to improve its performance. This could involve cost-cutting measures, expanding into new markets, making strategic acquisitions, or improving management practices. Finally, the improved cash flows from the business are used to pay down the debt over time. It's crucial to understand that in a leveraged buyout, the company that is acquired becomes responsible for repaying the debt, not the private equity firm itself. This often results in downsizing for the acquired company in order to pay down the debt from its cash flows. Part 6. Scandals and Controversies. Remember that 20% of profits go to the private equity firm as carried interest? Despite this being compensation for the work done by the general partners, it's not taxed as ordinary income. Instead, it's treated as capital gains. Why does this matter? Because in many countries, including the United States, long-term capital gains are taxed at a lower rate than ordinary income. For high-income earners, the difference can be substantial. As of 2024, the top federal income tax rate in the U.S. is 37%, while the long-term capital gains tax rate tops out at 20%. This means that the general partners in a private equity firm often pay a lower tax rate on a significant portion of their earnings than they would if it were treated as regular income. This is what's known as the carried interest loophole. Now let's look at some of the financial blunders by private equity over the years. The involvement of private equity in the Marsh supermarkets and Toys R Us scandals is a notable example of the risks and controversies associated with leveraged buyouts and the management practices of private equity firms. Marsh Supermarkets, a regional grocery chain based in Indiana, was founded in 1931. In 2006, the chain was acquired by the private equity firm Sun Capital Partners for $88 million. After the acquisition, Marsh faced significant financial challenges. Sun Capital Partners implemented aggressive cost-cutting measures and leveraged the company heavily. By 2017, Marsh filed for bankruptcy. Most of its stores were closed or sold off. Critics argue that Sun Capital's management strategy focused on short-term gains at the expense of long-term stability, ultimately leading to the chain's downfall. The use of high debt levels to finance the buyout added significant financial strain on Marsh, which struggled to service its debt amid declining revenues. Toys R Us, a global toy retailer, was founded in 1948. In 2005, it was taken private in a leveraged buyout by Bain Capital, KKR & Co., and Vornado Realty Trust for $6.6 billion. Post-acquisition, Toys R Us was saddled with approximately $5 billion in debt. The company struggled to adapt to changing market conditions, including the rise of e-commerce and competition from retailers like Amazon and Walmart. In 2017, Toys R Us filed for bankruptcy. By 2018, it announced the closure of all its U.S. stores, resulting in thousands of job losses. The heavy debt burden imposed by the private equity firms left Toys R Us with insufficient capital to invest in its operations and compete effectively. The focus on extracting value through dividends and fees, rather than investing in the company's future, is seen as a key factor in its demise. These scandals highlight several issues associated with private equity investments. High levels of debt can strain a company's finances, particularly if market conditions change or the company's revenues decline. Private equity firms often aim to realize returns within a few years, which can lead to cost-cutting and underinvestment in areas critical for long-term success. The strategies employed by private equity owners may not align with the operational realities and needs of the companies they acquire. These cases have fueled ongoing debates about the role of private equity in the retail sector and its broader economic impacts. Part 7. Implications for the layman. While private equity often seems like a distant concept for the average person, its impacts are far-reaching and affect many aspects of our daily lives. Let's explore some of these implications. Private equity buyouts often lead to significant job losses. When private equity firms buy out public companies, employment typically shrinks by 13% in the 2 years following the buyout. Private equity is responsible for eliminating more than 1.3 million retail jobs over the last decade. Cost-cutting measures frequently include layoffs, cutbacks in benefits, pensions, and insurance. Private equity investments in healthcare have increased more than 20-fold over the last 20 years, spanning nursing homes, hospitals, and ambulatory services. When private equity takes over a nursing home, mortality rates jump by 10%. This implies that private equity ownership causes more than 1,000 additional deaths every year on average, compared to non-private equity-owned nursing homes. Patient bills in private equity-owned healthcare facilities tend to rise more than 10%. Private equity is driving market concentration in healthcare. For example, KKR and Blackstone control 30% of the market for outsourced ER doctors. Private equity ownership of housing is associated with rising rents, higher rates of eviction, and lower quality of housing. Private equity buyouts of private colleges often lead to higher tuition and student debt, lower graduation rates and graduate earnings, and more law enforcement actions for fraud. Private equity has invested at least $1.1 trillion in the energy sector over the last decade, with 80% of that in fossil fuels. About half of all daily newspapers in the country are owned by private equity or hedge funds. 3 private equity firms control more than 90% of the prison telecom market. Bankruptcy rates among companies purchased in leveraged buyouts are 10 times higher than non-private equity-backed companies. Between 2015 and 2019, nearly 2/3 of retail companies that went into bankruptcy were PE-owned. Private equity has contributed to the growth in income inequality since 1980. There are more private equity managers who make at least $100 million annually than investment bankers, top financial executives, and professional athletes combined. The number of private equity multi-billionaires rose from 3 in 2005 to 22 in 2020. The typical private equity fund has failed to outperform the stock market since at least 2006. Despite this, the 4 biggest private equity firms collected $230 billion in performance fees over a 10-year period. This wealth transfer from pension scheme members to private equity professionals might be one of the largest in the history of modern finance. Nearly half of limited partners, which include investors like public pension funds, reported that more than half of the private funds they had invested in over the last year had contractually modified or reduced their fiduciary duties. The SEC found that about 50% of private equity firms it had audited had not shared the fees collected from portfolio firms with limited partner investors, even when required to do so. Many of the familiar companies are owned by private equity like Chuck E. Cheese, Staples, and Red Lobster. Many stores on the British High Street are controlled by private equity investors rather than independent shopkeepers or large multinationals. Post-Brexit, private equity investments surged in the UK, acquiring numerous high street names like Burger King, New Look, and Pizza Express. As laymen, it's crucial to understand these implications because they affect various aspects of our lives, from the stores we shop in, to the healthcare we receive, to the newspapers we read. Moreover, if you have a pension fund, it likely invests in private equity, making you an indirect participant in this industry. If you enjoyed this video, please give it a thumbs up. We are planning to make more videos like this, so please let us know in the comments what topics you want us to cover next. And don't forget to subscribe so you don't miss future videos. Thanks for watching, and see you next time.